You are staring at a red chart right now and asking yourself the same question millions of XRP holders are whispering into the void. If the fundamentals are this strong, why is the price this quiet? Let me give you the answer nobody on financial television will say out loud. At a very specific moment this week, the largest regulated derivatives exchange on planet Earth, an exchange that clears more notional value in a single trading day than most countries produce in a year, quietly flipped a switch that has never been flipped before in the history of regulated finance. They went 24/7, around the clock, weekends included. No more Friday close, no more Sunday gap, no more downtime between the institutional world and the crypto world. And the company sitting on the inside of that switch, named as a day one clearing and financing partner, was not Goldman, it was not JP Morgan, it was not Citadel, it was Ripple. What I am about to walk you through is not being explained to retail investors the way it should be. The mainstream crypto press is treating this as a press release. It is not a press release. It is the moment the plumbing of global derivatives finance was permanently rewired, and a company most of you were told was just a payment startup was handed a seat inside the engine room of a $1.2 quadrillion machine. Let me pull back the curtain. Welcome. On this channel we ignore the noise, we ignore the candle screaming, and we read the structure underneath the market. Today we decode 3 converging events: CME's 24/7 activation, with Ripple Prime as a day one partner, Ripple's RLUSD landing inside Turkey's regulated exchange ecosystem, and Kalshi's CFTC filing for XRP perpetual futures. And we map exactly what they mean when you stack them on top of each other. Let's go under the surface. Here is the hard truth. 95% of people reading the CME headline are staring at the wrong word. They are reading 24/7 trading and thinking, cool, now I can trade on Sundays. That is the surface. That is the distraction. The phrase you needed to circle was day one clearing and financing partner. To understand why that phrase changes everything, you have to understand how regulated derivatives markets actually function. When an institution, a pension fund, a hedge fund, a sovereign wealth desk wants to take a position on CME, they do not just click buy. They route the order through what is called a futures commission merchant, an FCM. The FCM is the gatekeeper. The FCM holds the margin. The FCM extends the credit line. The FCM clears the trade and finances the position when it rolls. Without an FCM, the institution does not trade, period. For decades, this layer has been controlled by a handful of names you already know, the same names that control prime brokerage on Wall Street. To break into that club, you do not buy your way in. You are invited in by the exchange itself, because the exchange has to trust your balance sheet, your risk systems, and your compliance posture with their reputation. CME just invited Ripple Prime into that club, on day one, for a 24/7 product, across every major crypto derivative they list. This is not a partnership announcement. This is Ripple being handed the keys to sit in the middle of institutional crypto derivative flow, with credit and financing rights on the most regulated venue in the world. Retail looked at it and shrugged. The custodians and the prime brokers in Manhattan and London did not shrug. They understood exactly what just happened. Ripple is no longer a payments company. Ripple is now a prime broker, and prime brokers do not get paid in hope. They get paid in basis points on flow. Let's do the math the retail crowd ignores. Charles Edward's son pulled the numbers, and they are worth repeating slowly, because these are the numbers that explain why I am calm when the chart is red. CME Group clears roughly $1 quadrillion in notional volume per year. That is a 1 followed by 15 zeros. The daily monetary equivalent of the contracts changing hands sits between $4 and $5 trillion per day. Open interest. The total value of active unclosed contracts pending at any given moment averages $100 to $120 trillion. Now layer in this fact, and I want you to actually pause on it. XRP futures became the fastest contract in CME history to cross $1 billion in open interest. 3 months. Faster than Bitcoin. Faster than Ethereum. That is not retail FOMO. Retail does not trade CME futures. CME futures require institutional accounts, margin minimums, and FCM relationships. That $1 billion of open interest came from desks, funds, treasuries, market makers. So here is the equation that matters. If XRP futures hit $1 billion in open interest in 3 months on a 23/5 trading schedule, what happens when the same product goes 24/7, adding roughly 30% more trading hours, with Ripple Prime sitting inside the clearing layer offering credit and financing to every institution that wants weekend exposure? The math is not subtle. More hours plus more financing access, plus a dedicated FCM that has every incentive in the world to grow XRP flow equals open interest that compounds, not adds. And here is the part that matters for the token itself. Derivatives demand creates spot demand. It is not a one-to-one relationship, but market makers who write XRP futures contracts hedge their books by holding spot XRP. Custodians who finance those positions need collateral. Collateral that gets locked, not traded. If XRP captures even half of 1% of CME's annual notional volume over the next 36 months, you are talking about $5 trillion of XRP-denominated derivative exposure flowing through a network whose total fully diluted supply is 100 billion tokens, of which roughly 55 billion are circulating, and an increasing percentage are sitting in cold storage on institutional balance sheets. This is not a prediction. This is the logical mathematical outcome of a fixed supply asset being plugged into a $1 quadrillion pipe. While retail investors are panic selling because the candle is red and the influencers are quiet, look at what the institutional signal is actually saying. Ripple did not announce CME alone. In the same window, Ripple announced that RLUSD, its enterprise-grade US dollar-backed stablecoin, is now live across 3 regulated Turkish exchanges: Bitexen, BTC Turk-affiliated venues, and Bitlo. Turkey is not a footnote. Turkey processes more than $200 billion in annual crypto transaction volume, nearly 4 times the next largest market in the MENA region. RLUSD now sits at $1.7 billion in market capitalization and is the fastest-growing compliance-first stablecoin in the world. Then, in the same week, Kalshi, a CFTC-regulated prediction and derivatives venue, formally filed with the CFTC for XRP perpetual futures. Kalshi does not file a service certification with the CFTC casually. That filing is a structural commitment. It means a second regulated US venue is preparing to list XRP perpetuals. And the only reason a venue files for a product is because the institutional desks they serve have already asked for it. Stack the picture. 4 Sweeney flips 24/7. Ripple Prime sits inside as clearing and financing partner. RLUSD enters the 3rd largest crypto market on Earth through regulated rails. Kalshi files for XRP perpetuals with the CFTC. XRP spot ETF flows in the US are now running multi-day positive streaks, with cumulative locked supply marching toward the 1 billion XRP threshold. Ask yourself this brutal question: does a regulated derivatives exchange that clears $1 quadrillion a year hand day one clearing rights to a company without absolute legal certainty about that company's regulatory standing? Does Kalshi file a CFTC perpetual product on an asset whose status is in doubt? Does a Turkish licensing regime, rebuilt in 2024 specifically to attract institutional capital, allow RLUSD onto its 3 largest exchanges without confidence in the issuer? No, they do not. They cannot. The legal architecture has already been built quietly behind the curtain, and what you are watching now is the activation phase. The smart money is not betting on clarity. The smart money has already been told clarity is here, and they are positioning before retail understands what that means. Let me lay out the catalyst sequence as I see it from the data, because the timeline is no longer abstract. Right now, CME 24/7 is live. Ripple Prime is clearing. Open interest in XRP futures is compounding on a schedule that did not exist last week. This quarter, Kalshi's CFTC filing moves through the certification process. If it clears, you get a second regulated US venue listing XRP perpetuals, which adds a permanent bid from market makers who need spot collateral to hedge. Through the second half of this year, RLUSD expansion continues across Turkey, Japan, Australia, and African corridors. Every new corridor RLUSD enters is a corridor where XRP can be used as the bridge asset between RLUSD and local fiat, because the XRP ledger's decentralized exchange treats every currency pair as a routable graph. Ripple already supports the FX rails for roughly 90% of the global currency map. Into next year, tokenization volume on the XRP ledger, currently in the early billions, is on a trajectory that institutional research desks at the major banks are now modeling toward the $4 trillion tokenization wave that BlackRock, Franklin Templeton, and Fidelity have been openly preparing for. When the catalysts land in sequence, the current limitation, the perception that XRP is a speculative retail token, vanishes. The wait-and-see capital becomes the all-in capital. That is how every regulated asset class has transitioned in modern financial history. Equities did it. Fixed income did it. Commodities did it. Crypto is doing it now. And XRP is being positioned as the rails. Here is the part that should make you sit up. We are moving from an era of XRP abundance to an era of XRP scarcity. And the transition is happening faster than the price chart suggests. Spot ETF inflows in the US are now consistently positive on multi-day streaks. Every XRP that enters an ETF wrapper is XRP that is custodied institutionally and does not return to the open market for a 10% profit. It is gone, locked behind the cold storage walls of regulated custodians who answer to fund mandates, not to candle patterns. Now layer in the new buyers. Market makers writing CME futures need spot to hedge. Kalshi's perpetual product, once live, creates the same demand. Ripple Prime, as a clearing and financing partner, needs balance sheet inventory. Treasury desks adopting RLUSD will increasingly use the XRPL's native bridge mechanics, which means XRP is consumed in the routing. Meanwhile, the supply side does not move. 100 billion tokens, fixed, no inflation, daily burn from network activity, escrow releases that are largely relocked, exchange reserves trending toward multi-year lows. You are watching the institutions spend the back half of 2025 and the front half of 2026 doing exactly what they did with Bitcoin between 2020 and 2023, quietly draining the float while the retail crowd argues about whether the bottom is in. When the float is drained, the price does not climb. It gaps, and once a token enters a multi-sig institutional vault, it is not coming back to fund your re-entry. The window where you can still acquire XRP at three-figure cent prices is not a permanent feature of this market. It is a transition phase. The institutions have spent years trying to shake out the impatient so they could take the position. That is not conspiracy. That is the documented behavior of every prime broker that has ever participated in the launch of a new asset class. I know watching the chart right now is painful. I know the headlines feel disconnected from the price. I know the influencers who were loud 6 months ago are quiet, and the silence feels worse than the volatility. But as an analyst, I am trained to do one thing: distinguish noise from signal. The noise is the candle. The noise is the funding rate. The noise is the social media sentiment that swings on a 48-hour cycle. The signal is structural. The signal is a regulated quadrillion-dollar exchange, handing clearing rights to Ripple. The signal is a stablecoin issued by Ripple landing inside the third-largest crypto market on Earth through fully regulated rails. The signal is a second U.S. derivatives venue filing for XRP perpetuals with the CFTC. The signal is multi-day positive spot ETF flows, accumulating into permanent institutional custody. Being early feels exactly like being wrong, right up until the moment reality catches up with the math. And the math here is not ambiguous. The infrastructure is being plugged in. The regulated venues are activating. The stablecoin corridor is expanding, and the supply is quietly leaving the float. The question is not whether the structure will resolve. The structure is already resolving. The question is who will still be holding the asset when the resolution price is in. Price is a distraction. Structure is the reality. What CME did this week, with Ripple Prime sitting on the inside of the switch, is not a partnership headline. It is the moment a payments company became a prime broker inside the most regulated derivatives venue on Earth. What Ripple did in Turkey is not a regional rollout. It is the activation of a stablecoin corridor inside a $200 billion market. What Kalshi filed is not a routine certification. It is a second U.S. venue confirming that the institutional appetite for XRP-denominated derivatives is real, regulated, and accelerating. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the laws of arithmetic. In a market fueled by emotion and noise, we thrive on data and composure. The math does not lie, and the system is almost complete. Stay patient, stay rational. And as we always do, we do not wait for the future, we position for it. If you made it to the end of this breakdown, drop the word plumbing in the comments. I want to see who actually understands what just got built this week.